But there's also some upside potential, particularly from the relaxation of COVID-19 restrictions in China, particularly for services such as travel and transport. And of course, a peaceful end to the war in Ukraine and a reduction in broader geopolitical tensions would also greatly improve the outlook for the global economy. Now, turning to the situation in 2022, so what happened last year, the beginning of the war in Ukraine in late February 2022 delivered another blow to a global economy that was still dealing with the after effects of the COVID-19 pandemic. And supplies of essential Ukraine and Russia, particularly grains and energy products, caused commodity prices to spike and forced importers then to scramble to find alternative sources of supply. These commodity price spikes then exacerbated inflation, which was already picking up globally as a result of supply chain disruptions and the extraordinarily accommodative monetary and fiscal policies adopted during the pandemic. Interest rate hikes by central banks did not immediately succeed in dampening growth and inflation, but then, by the end of 2022, the impact was felt as commodity prices receded and GDP growth slowed. COVID-19 outbreaks in China then also weighed on trade in the fourth quarter of 2022, even though, as I already said, a relaxation of controls promised to provide a boost to the global economy going forward. During the first 3 quarters of 2022, year-on-year trade volume growth was actually stronger than expected at 4.3%, which means that trade proved to be remarkably resilient to the war in Ukraine, which is an observation we already discussed in detail in an earlier report that we issued in February. You can download that from our website, and I would very much encourage you to do that. Now, the strong initial performance, however, in 2022 was followed by an abrupt decline in the fourth quarter of 2022, which then dragged trade volume growth, that is, for the year down to 2.7%, which is weaker than our forecast of 3.5% from last October, but still quite close to our initial estimate of 3.0% from 1 year ago. Several factors contributed to the trade slump in the fourth quarter, including the rising COVID infections in China, which I already mentioned, but also the monetary tightening throughout the year, which then started to have an effect starting in Q4. Our Director General, Dr. Ngozi Okonjo-Iweala, has also read the report and stresses, and I can quote her here, that trade continues to be a force for resilience in the global economy, but it remains under pressure from external factors. This makes it all the more important for governments to avoid trade fragmentation and to refrain from introducing new obstacles to trade. Investing in multilateral cooperation on trade, as WTO members did at our 12th Ministerial Conference last June, would bolster economic growth and help raise living standards over the long term. That's the end of the quote. So before we open to questions, then let me hand over to my colleagues Coleman and Barbara, who will expand a bit on the forecasting methodology, but also regional trends and trends in services trade. Thank you.
Thanks, Ralph. Thanks, Ismaila. And thank you all for being here. I'll keep my remarks brief. I'd just like to draw your attention to a few interesting aspects of the forecast for 2023 and also some developments in 2022 that feed into the current year. Regarding the regional breakdown of trade growth in 2023, we expect world trade to be weighed down by weak import demand in North America and Europe, where imports will be stagnant to negative. Imports should contract by 0.7% in Europe and 0.1% in North America, which is basically flat. Europe is dominated by the European Union, which accounted for 81% of the region's imports in 2022. Like other organizations, we count intra-EU trade as part of our world trade totals. So any weakness in Europe will be disproportionately reflected in the global total. EU imports will be negative in 2023, partly because of exceptionally strong extra EU import growth in the second and third quarters of last year. We can't really say for certain what drove this, but part of the story may be the scramble for energy supplies as Europe tried to find alternative sources of energy after Russian oil imports were cut off. Turning to North America, this region is equally dominated by the United States, which made up 74% of North American imports in 2022. Import volume growth will be weak, partly as a result of, once again, the strength in the first half of the year, and so you get this base effect. Unlike the EU, this probably had less to do with trying to import more energy, because the United States is relatively energy abundant, but more likely it had to do with tightening monetary policy having an effect and slowing GDP growth over the course of the year. China is less dominant in the Asia region, accounting for 33% of total imports. Still, with such a large share in the region, we can get a good sense of the rough trends for China and its impact on global demand. Asia's import volume in 2022 is expected to grow by 2.6%. Oh, sorry, in 2023. This is weak by historical standards, but still above the world average of 1.7%. So Asia will once again be making a disproportionate contribution to global demand for traded goods. Africa, the CIS, and the Middle East will also, all three of those regions will see above average import growth, while South America's imports will contract slightly. The CIS will actually see a 14.9% increase in imports if our forecast comes to pass. But this represents mostly a rebound from the 13.5% decline in 2022. And if this forecast is realized, trade volume in the CIS group will be actually slightly below where it started because of the base effect. Turning to the export side, North American export volume exports will grow faster than any other region at 3.3% in 2023, followed by the CIS at 2.8%, Asia at 2.5%, and Europe at 1.8%. Once again, CIS growth in 2023 will follow a sharp decline of 4.9% in 2022, which will leave its exports below their pre-war level. Export volume growth in Africa, the Middle East, and South America will also be weak to negative in 2023. And this is actually normally the case with countries and regions that export natural resources, and particularly oil, disproportionately. The volumes tend to be quite stable. So finally, I'd like to review some of the efforts that we went to in forecasting 2022 and how our projections turned out. We had little hard data to work with last April due to the invasion of Ukraine, and as a result, we had to use simulated GDP statistics based on our global trade model, which actually turned out to be quite close to the mark. Our April forecast was for 3.0% merchandise trade volume growth in 2023, and in 2022 rather, and it ended up being 2.7%. So not that far off. Our forecast in a mid-year update in October was upgraded to 3.5%, but part of that was because of the strong upside performance in the first half of the year. But then this was undercut by the slowdown in the fourth quarter. These revisions are not exceptionally large because trade tends to be quite volatile compared to global GDP. And so overall, our estimates turned out to be quite close to the mark, especially considering that we had relatively little data to work with. Okay, I will leave it at that. And Barbara.
Thank you, Coleman. So after 2 difficult years, services trade finally exceeded pre-pandemic levels in 2022. international travel resume. And this has benefited several regions, but in particular the Middle East, the Central and South America and the Caribbean, and also Africa. All these regions, they enjoyed very strong services exports growth. Now, as Ralph mentioned, international tourism is on a path to full recovery as mobility restrictions have been removed worldwide. Transport had also had another record year with trade up 25% in 2022. And this was, as we know, due to surging shipping prices. And in Asian economies, transport exports were 73% above their 2019 levels. However, transport trade growth slowed during the year as freight rates started to decline steadily since the spring. And now they have returned to pre-pandemic levels. And this reflects, on one hand, the shift back of consumers to spend on services, and on the other, the adverse economic and geopolitical context which have reduced global demand. Now, moving to other commercial services, the appreciation of the US dollar against major currencies, but especially against the euro and the British pound, is partly responsible for subdued trade growth in 2022 at only 2%, as you can see in our chart. The European Union and the United Kingdom accounted for half of the trade in these services in 2021. And just to say that they, in turn, form almost 2/3 of services trade in 2021. But as Ismaila mentioned, today we are also releasing a new data set on digitally delivered services exports. Digitally delivered services comprise a wide range of very different services, from business to financial services, computer services, streaming of music and video online, remote learning, and many others. And these services are traded cross-border through computer networks. That means through the internet, apps, emails, but also voice and video calls, and increasingly through digital intermediation platforms. And the fact is that trading in digitally delivered services is booming. According to our estimates, global export reached $3.82 trillion in 2022. And what is impressive about these services is the pace of growth. An almost fourfold increase in value since 2005, 8.1% rise on average per year since 2005, which outpaces growth on goods side at 5.6%, and other services exports, which cannot be delivered digitally, at 4.2%. In 2022, digitally delivered services accounted for 54% of global services trade, and what is more interesting is that they account for a fast-growing share of total trade, meaning goods and services together, which we estimated at 12% for 2022 from 8% just a decade ago. And this gives us a clear signal that the future of trade is services, and it is digital. And as you can see, the report contains some insight into regional performances. I will not go into those details, but just to tell you that also the full data set by country and by region is available on our website. Thank you very much.
Thank you, Barbara. I would like now to open it to questions. So if you are in the room, just raise your hands and I will call on you. For colleagues who are joining us online, also you can click on the raise your hand button, or you can send written questions. Please identify yourself and your organizations. So the first question will go to the lady in green. Agnès.
Yes, thank you. Agnès from Agence France Presse here in Geneva. Thank you for taking my question. I would like to have a comment on your side on your expectation for 2024. You are expecting a rebound, and I wanted to know why are you so optimistic for 2024? Thank you.
It's not particularly optimistic. I mean, it's sort of global GDP is expected to return to more normal levels, and trade growth is expected to rebound in line with that. The rebound is slightly stronger, but that's just part of the nature of trade. Trade tends to be more volatile. So when world GDP increases, trade tends to increase more. When world GDP declines, trade tends to move in the same direction, but just more so. So you get a kind of a whipsaw effect, but it's a kind of a reversion to the mean. And I think that it's not exceptionally strong, but we do see, based on current expectations for the global economy, a slight recovery in 2024.
Well, maybe I can. Sure. So I guess one thing I could add. So he mentioned this whipsaw effect. You mentioned it. And one reason for this. I mean, there's many reasons for this, but one reason for this is that trade. Capital goods are quite important in trade, and demand for capital goods, of course, responds to investment. We know that investment is pro-cyclical, but is responds very, very strongly downwards in downturns and very strongly upwards in upturns. And that's one reason, why you get this kind of excessive volatility in trade flows.
Thank you, Ralph. The gentleman in the black sweater.
Yeah, thank you, Laurent Siro from the Swiss News Agency. A question to Ralph Fossa, because you briefly mentioned the weakness of the banking system, and you know how hectic the topic is in this country now. So could you elaborate a little bit on what could be the forecast, depending on different scenarios by the central banks, in terms of connection with trade, and maybe a regional breakdown on that? Thank you.
So I won't be able to give you, that much detail, but what I can say is I can kind of illustrate some of the mechanisms, through which, these financial conditions start to matter for international trade. And you mentioned monetary policies, so let me maybe start with that. So, of course, what we did see is the monetary tightening in 2022, and as I said, in the fourth quarter of 2022. That I think contributed significantly to the decline in trade volumes, and also then now moving into 2023, I think is a major reason why we expect GDP growth in 2023 to be so low, and therefore also trade growth to be so low. So that's kind of the big picture. If I go a little bit more now into some of the details, so you're saying banking crises, what could that have to do with international trade? Short of these effects on aggregate demand. So one important channel potentially is trade finance. Trade finance is kind of short-term finance, and typically responds quite strongly to crises or difficulties in the interbanking market, for example. So that's where we would see one of the risks, but I won't be able to give you more detailed breakdown there.
Yes.
Yes. I just point out that our forecast, we don't have different alternative scenarios, but we do have sort of confidence intervals and a range of possible outcomes, depending on combination of statistical variation, but also our subjective sense that the risks are more on the downside. And on page 4 of the report, we note that in 2023, trade growth could be as low as minus 2.8% if the very worst scenario comes to pass, or as high as 4.7% if outcomes are better than expected.
Thank you, Coleman. The gentleman on the left, yes.
Assis Moreira, Valor Econômico, São Paulo. What's the prospects for the commodities in your forecast? What are you estimating for this year, especially for countries in Latin America?
Well, we don't produce specific forecasts on commodities, but we did have a big spike in commodity prices that peaked in more or less August of last year. And since then, commodity prices have fallen substantially. What we do is then we assume that commodity prices will gradually return to sort of their medium-term average. So we don't make specific projections about commodity prices, but in 2023, these prices will be certainly lower than they were last year. So some regions like for instance, Africa, South America, where there are weak or declining export volumes, you combine that with lower commodity prices, and they could see a sharp decline in export revenues compared to 2022.
Thank you, Coleman. I will go to the middle of the room. Yes.
Thank you. I'm Shen Yi, China Media Group. My question is for Mr. Osa. Compared to last October's estimate, it's a big jump from 1% to 1.7%. So why is WTO more optimistic? What is the positive role of China? Second question is, in the press release, DG said the trade will remain under pressure. It's more important for government to avoid trade fragmentation and refrain from introducing obstacles to trade. According to media reports, there is an agreement between the United States, Japan, and the Netherlands on export restriction of chips. So do you think this agreement is an obstacle to trade? Microchips is like hundreds of billions business. How will this agreement have a negative impact on global trade? Thank you.
Thank you very much for these questions. So let me start with the first one. So you're right that our forecast has increased from 1.0 to 1.7%. The main reason for this is the slightly improved outlook also for GDP, which we actually don't forecast ourselves, but we just kind of take so it's a consensus estimate. Basically, we combine it from other forecasts, and as we explained before in the response to your colleague, trade tends to respond quite strongly to changes in GDP. For example, because there's a lot of capital goods and trade. That's just one example. So this is one factor. You asked about the specific role of China, and I think that's actually the second factor. So we had the spike in COVID infections in Q4 of 2022, which kind of didn't help trade at the end of 2022, but going forward. The fact that China seems to be over that now, I think, is going to help trade growth, in particular growth in services trade, such as tourism. And to the second point, I mean, you have to ask the DG, of course, if you want a response to kind of a quote by her. What I can tell you is that open and predictable and free trade, I think nowadays are as important as ever, or I would even say more important than ever. Let me give you one example. When we kind of studied the response of countries to the supply shock following the war in Ukraine. So in particular, countries in Africa that were heavily exposed to exports of wheat, say from the Ukraine and from Russia. What we did see in the data is that they were able to kind of respond to these supply shortfalls quite swiftly by securing alternative sources of supply. So Ethiopia, for example, started to import a lot from Argentina, started to import a lot from the US. And that shows you the importance of open markets also for economic security. And that would be my response to your question there.
Thank you. So I just would like to add about the role of China on services trade and just a follow-up of what Ralph was mentioning. Prior to the pandemic, China was the largest outbound tourism market and the largest spender. And this has contributed over the years to GDP growth in many developing economies, especially in the regions which have suffered in terms of travel earnings losses during the pandemic. So the reopening of the borders really will really give a boost, especially to intra-regional travel. And we think that China can make a very important contribution to the recovery of these economies. Thank you.
Thank you, Barbara. Isabel, yes.
I would like to know, following a little bit what was just said, what has been the impact of the in the slowdown of the growth of global trade, of the export restrictions from Ukraine, especially in grains and grain oils, and also the export restrictions from Russia because of the sanctions. Thank you.
Thank you very much for this question. So there, I would refer you to the report we issued in February, where we kind of analyzed this in some detail. But I can tell you two things. So the first is, basically what I just said before, that countries that were heavily exposed to these to falling exports from Ukraine and also Russia, both in energy products as well as in food products. By and large, were able to cope quite well, by securing additional, by securing alternative sources of supply. Sometimes also switching to other goods. So Turkey, for example, started to import a lot of rice to substitute for the, shortfall in wheat. And again, to me, this, really is a clear indication of how important it is to have open markets. In some sense, outside options are what you need in times of crisis, and outside options is exactly what the multilateral trading system gives you. That's one thing I can say. The other thing I can say about the sanctions. So we do report in our previous note that the change in Russian exports does seem to be broadly in line with what you would expect given the sanctions. So trade volumes increased, particularly with, and this is in value terms, so trade values, I should say, increased particularly to China and India, but decreased particularly with respect to the US and the UK, with Europe being somewhere in the middle, given the strong ties in energy markets.
Thank you, Ralph. We will take a few questions online. I will go to Hannah Moniken, Inside US Trade. Hannah. Hannah, you have the floor. Yeah, she's got it. Yep.
Yes, we can hear you. Yeah, that's a good question. Of course, what governments, what action governments could take. I would say as Coleman pointed out before, one of the main kind of risk factors here is, of course, the other geopolitical tensions and the effect they can have either directly on international trade or indirectly through commodity prices, to which central banks they need to respond and so on. So I would say keeping geopolitical tensions low would be very helpful when it comes to international trade growth next year.
Thank you, Ralph. I will now call on Gabriela Sotomayor from Proseco, Mexico.
We have a bit of a hard time understanding you, but I think you're asking about the outlook for Mexico. Coleman, do you want to say something about that?
Yes, we don't produce forecasts for individual countries, although we do have a forecast for North America, and so Mexico's trade outlook would depend to a large extent on that. I could point to 2022 when Mexico's export volume actually rose 8.3%, and its import, which was in excess of the region's 4.2% growth. So exports from Mexico did relatively well in 2022, and its imports were roughly in line with the regional average at 5.7% compared to 6% for North American imports overall. So, our outlook for North America exports at the moment is in 2023 is actually stronger than the world average. So 3.3% is what we're projecting for this year, and so Mexico would contribute to that. But on the other hand, imports of the region are expected to be basically flat, contracting by 0.1%. So that's Mexico would be in part of that figure, although it's dominated by the United States, of course.
Thank you, Coleman. I don't see any other questions online. Do we have one last question from the room before we close? Yes, Isabella.
Thank you. It's just on the call to avoid fragmentation. I would like to know how do you see things in this area?
I can tell you a little bit about that, fragmentation, deglobalization, that whole debate. And, I typically distinguish between three layers. So the first layer is what has happened in terms of the narrative. And I think there, we really see quite some change. So, I think it used to be the case that people viewed economic interdependence as a good thing, as something that would bring prosperity and also security. I mean, just for example, think about European integration. The whole point of European economic integration was to make countries like Germany and France, who were not allies at the time, as you know, trade more, so become more interdependent. So there used to be the sense that this was a good thing, and I would argue that this vision has guided policymaking for a long time. Now we see a kind of a complete U-turn as far as this narrative is concerned, and given some of the shocks that we have experienced in past crises, I think now economic independence, at least independence from some countries, is viewed as a plus. So that's in terms of the narrative. If you go the next level down and think about policy, so what effect did this have on policy? I would say, well, of course it did have some effect, or it's starting to have some effect. I mean, think about the trade tensions between the US and China. You see, the tariffs that are in place there, but we also see other developments, of course, at the moment that are pointing in that direction in the policy space. But then if you go one step further, so to the third layer, and ask, what implications has this had for international trade flows? I think there we see, at this point, not that much in the data. Trade between the US and China, for example, is at a record high. And of course, if you take out the magnifying glass now, you start seeing certain, signs of problems there too. But, those are really the three kind of layers I see, which adds up to kind of a situation where, we've kind of changed course, I think, where globalization is headed, but I think there's still time to turn it around. And I think we should think carefully where we want to head.
Thank you, Ralph. This will bring an end to our press conference today. I want to thank Barbara, thank Coleman for being with us today, and thanks for our colleagues from the press for joining us today, here in the room and online. Thank you, and we will see you at our next press event.